This is Aztlan Equity Management's first monthly market view and analysis live web event. We're publishing on LinkedIn live, January 30th, 2025. So we're getting started, almost done with the first full month of the year, 2025. President Trump is now starting his second term. We have the recordings and the notes from yesterday's Federal Reserve meeting, in which it was decided to keep rates steady on pause for now. So with that as context, let's go right into the monthly market view and share with you what we want to do is share with you some of the key data points, analysis that we're seeing in the management of our equity strategies or our investment strategies in general. So first of all, we now have the full recovery. It's been one of the longest on record for the S&P and for the Nasdaq indices. Russell 2000 is also back to the previous high. Took well over 2 years for the small caps. Small caps haven't performed all that well, but at least they have recovered already, and I think we're now in a much better situation for the small caps, particularly as they have lagged the rest of the market and the large caps in particular. The key thing that we're seeing is a very expensive market. It's never been this expensive over the last 20 years. It's probably one of the times in history where we've seen maximum valuations. What we're seeing here on the left-hand chart is the price to earnings valuations, historical and forward, and the average and standard deviations. So we're well above one standard deviation, trading at 22.3 times price to earnings in the case of the S&P 500. But the companies are also growing a lot, and we're seeing growth rates that are well above averages. So 14.2% for the S&P 500. If we zoom in into the larger companies, what it's been called the Magnificent Seven, we see that we all know these companies have been driving the market. At least that was the case all through 2024. And if we strip that away, we can start, seeing and evaluating what even small change in allocations from the large and mega caps into the small caps could imply, just looking at the relative sizes in terms of market caps that we see on the right-hand chart. Russell 2000, just a tiny fraction of the Magnificent Seven as a group. If we do the same in terms of valuations, what we see is that group, the 7 largest companies, or the Magnificent Seven, they're kind of average, right on average in terms of valuation multiples. But given that these companies have performed so well and grown so much, also in terms of the percentage of the index, that has been driving valuations as a whole to higher levels. But if we look at the rest of the market, then the valuation multiples are not that expensive. We're still in above average territory, but not as high. Now, the key thing here to consider is that this situation that we have right now is well supported by fundamentals. So we look at return on equity in particular. We're looking at return on equity levels that we have never seen in recent past. If we look at the larger companies, 62%, the S&P on average 22.3%. The smaller companies a lot lower with 7%, a lot more in line with normal standard return on equity. And then the rest of the world, or MSCI world, 12.6% return on equity. So we're seeing a phenomenon in which the larger companies, by way of introducing and adopting technology and developing technology, are becoming a lot more efficient in their business models. They're also becoming a lot more dominant in their market positions, and therefore they're commanding higher returns, both by profitability and by capital efficiency. So we need to keep that in mind. It's not only that the markets are expensive, it's also that markets are growing a lot, and our companies are really efficient in terms of capital allocation. Then going over the G7 cyclically adjusted price to earnings and overall asset prices, what happened 2024. I think interesting to see. Well, we know that the US is very expensive, but so are all the other major economies or markets in Europe and in Japan. Interesting that the Nikkei index was up 19.2%, third best after gold, which was the top performer, 27.6, and the S&P 500, 25%. Looking a little bit into the macro picture, US inflation coming down from those very high levels that we saw during the pandemic, all the disruptions that a global health crisis brought to the global economy. But as we saw yesterday, we're stuck there in a range that is still above the 2% target. And so in terms of what we expect for interest rates, as we saw yesterday, we think the reasonable path is to see a pause in terms of the rate cuts. The US economy is strong, it's healthy. Inflation is still not coming down to the levels that have been targeted. So I think it's reasonable to expect that we'll see some pause there. Japan, I think, is an interesting example coming out of a very extended period in which the economy was stagnant. So we had a stagflation situation in Japan for a couple of decades. Finally, after the or during the pandemic, we saw that reflation happening finally in the economy, and then now we're seeing a back to normal situation there. We think that the currency has adjusted, so we're looking at reasonably favorable conditions in Japan. Canada, similar to the US, but at least from the latest data, we see more favorable inflation data coming out of Canada. In the US, well, the key driver there remains services. So the expectation is we'll see this pause in interest rate cuts. But we continue to see a very strong US economy, strong consumer demand, employment metrics, etc. CPI across the globe and policy rates. I think now if we compare this with where we were a year ago, a year and a half ago, it's very evident that there's a lot of progress that's been made, a lot closer to normal conditions. And I think if we look at the yield curves across the different economies, different central banks, we see a similar situation, basically normalizing across the globe, therefore setting conditions for stability, which in general are favorable for equity markets. The US economy growing strongly, strong GDP growth quarter over quarter. Slightly less strong in the case of the euro area in terms of GDP growth. Japan, but also showing still relatively favorable conditions. The US dollar strengthening across all currencies. And in terms of commodities, we see there, interestingly, the oil price very stable over the last year. A couple commodities like cocoa and coffee with those strong repricing effect. And then iron, soybean, palladium, some other metals and mining commodities on the bottom end of that chart. And finally, in terms of the macro picture, again, turning back to the US economy, consumer confidence with showing good levels, initial claims. We think these are good, normal metrics that we're seeing here. The economy remains strong, employment remains strong, inflation, we made a lot of progress over the last couple of years, but still some extra effort to be made. But we see good conditions and especially very strong corporate earnings. Before going into valuations, I wanted to just briefly show here on my screen the earnings season so far, just to add to that last point. Out of 151 companies that have reported this quarter, this earnings season, we're in the middle, or perhaps in the first half of that earnings season. 151 companies out of the 501 of the S&P 500 have reported, 10.5% above consensus. So still consensus estimates lagging behind what companies are actually doing, and showing a 23.3% earnings growth this quarter over the same quarter a year ago. Very healthy conditions, corporate earnings very strong, especially in the US. So that takes us to this chart, which is relative valuations. The US equity market is very expensive. It's something that we've been monitoring over the last couple of years, and it's a trend that continues. And our thesis is that it's actually very simple. It's precisely because of the fact that US corporate earnings are very strong. US companies, especially the larger companies, the large and mega caps, have become more efficient, more profitable, ROEs at historically high levels. So we see this discount across all the different regions compared to the US, Japan, Europe, world. Actually now one standard deviation below the 20-year historical average in terms of the valuation multiples compared to the S&P 500. And also the same case for emerging markets. Same situation we see across Canada, Australia, the Nordics as a group, and the UK. Same situation. So it's hard, it's difficult, because the US equity market is super expensive, but it's also super profitable. And in the end, as we know, the ultimate driver for shareholder returns is earnings. And so it's obviously very important valuation. Price you pay for those earnings that you're buying. But if those earnings are high and those companies are high quality, and there's a trend or an expected trend that can continue to grow, then you have a very difficult situation. It's not that simple in terms of saying it's too expensive, let's get out of the market and wait and see. There's a lot of value that can be lost with that kind of approach. If we look at the EPS growth, as I mentioned, we're above average, but it's really the capital efficiency more than the growth that I think is driving valuations in the US especially. Very similar in terms of the earnings growth trend, US and world. But then if we zoom in and look at the US case and compare the earnings yield with where interest rates are, 10-year treasuries, and do that comparison, we look at this analysis, calculate the historical average spread, which for the last 20 years has been 3.5%. That's the premium that over the last 20 years equities have paid above the 10-year treasuries, which makes sense given the risk, the extra risk that you're taking in the equities. But today, given current valuation levels and where interest rates are, there's clearly a market dislocation here. We're at negative 0.1. So so the market is willing to pay a premium for owning risk versus owning risk-free 10-year treasuries. Market dislocation, not predictive of anything, but for sure, conditions that are quite unique that and therefore we think, shouldn't it should be difficult to see these conditions to sustain over time. What we show in these charts is if we kept everything stable and just moved price to see what it would require in terms of price movement to come back to the historical average, the 3.5% spread, and we see it's a 45% correction. So as a consequence of this, or a conclusion of this, is there's either a scenario in which the equity market, the S&P, goes down by 45%, which, if you remember the very first chart, that would be one of the largest corrections in history. Or we have 2 or 3 years of zero price movement, and then the earnings growth takes back to equilibrium, this previous chart on the right. Or the third option is we have a new equilibrium driven by profitability, by capital efficiency, and valuations justified in that scenario. Higher valuations are justified in that scenario. We don't have an answer. We don't know which is the right answer. What will evolve from this point. But what we do know is that return on equity for the U.S. market is at its one of its maximum levels, at least maximum in the last 20 years. It's a trend that started maybe 8 years ago, basically right after the global financial crisis, maybe 15 years ago, and it's decoupling from the rest of the world and from the historical averages and from the world averages in terms of how profitable and how capital efficient American large and mega corporations have become and seem to be on a path to continuing this kind of trend. Then, if we look at the regression analysis using price to earnings, valuations, and fundamentals like earnings growth and return on equity as the starting point, and then try and calculate what is the expected return, we find that even as expensive as the US market is, we still find scenarios or analysis data in which there is still upside for the next 12 months. As we can see here, if we look at the P ratio, we're looking at 11.4% return. ROE, interestingly, surprisingly, but I mean, you can see the chart, it's all over the place. It's not a high correlation. It's not predictive of anything. Kind of 0.3%, very flat. 11.7% return, as we mentioned, for expected growth. And what else? And then we do the same analysis for the world. World ex-US, Europe, Japan, Canada, Australia, and the Nordics. Finally, the UK. And this is kind of the summary across the different regions or countries. USA, Canada, the European Union, the Nordics, Japan, Australia, and the UK, basically the developed world, where we focus our flagship strategy, the Aztlan International SMID strategy. We're looking at positive returns for the next 12 months. In the case of the US, on average, 7.8%. In the case of Japan, 4%. The Nordics, 6.1%. So low to mid single digit returns on average for the next 12 months. So that's the general view. Two final comments before moving on to the quant model allocations. We recently made some enhancements to our selective Aztlan index. These changes have performed relatively well. We're happy with the changes. Performance is still there. Here, obviously, we're showing through December. This month of January, up until today, has been really good performance. Basically, we have recovered what we lost last month in terms of performance for the index. But what's interesting is we're keeping up with good performance, but lowering the turnover with some enhancements that we have introduced derived from our quantitative process. Basically, we developed a stability score that allows us to select companies that are more stable in terms of where they rank within the top decile, so that we don't have to constantly change within the benchmark those selections that come into the index based on fundamentals and fundamental factors. So I'm very happy with those changes there in our selective index, with this mid international global. And then finally, for our nearshoring index, we had a challenging year last year. Obviously, the nearshoring narrative is challenged or has been challenged with some of the situations and conversations that have been derived from President Trump's second term, and conversations or confrontations between the two North American commercial partners, Mexico and Canada. So all that has been challenging. What we're looking at in terms of the index, the Aztlan North American Nearshoring Index, is implementing kind of similar enhancements as we did for the small and mid-cap index, broaden the scope of the selections, and hopefully have a much better performing index for the nearshoring theme. More to come there. Stay tuned. And as a final slide for this presentation, just based on the analysis, the regression analysis, and the corporate earnings and corporate earnings growth that we're seeing, we think that there's a positive outlook for equity markets for the next 12 months. But obviously, valuations are very expensive. Valuations are very high. As we saw with the Fed stock valuation model, it's really out of line. And evidently, something's got to give. So those are the things that worry us. But we think that on balance, the situation is positive. Basically because earnings growth is still there, and we have, broadly speaking, a lot of stability in global markets. Now I'd like to move on to the next presentation to finalize our live LinkedIn webcast today. the Aztlan quant model factors and allocations. So as you know, we have a quant model, a proprietary quant model. It's the first step in our process. We incorporate fundamental factors into the model, and then the model allows us to do basically two things. Number one, rank stocks from top to bottom across the entire investable universe. And number two, aggregate those stocks and their rankings in order to assess regional and sectorial relative attractiveness and allocations. And that's what we do and what we show here in this chart. First of all, we go over this mid-cap model, and we show the factor returns for the last month, which is the yellow bar. Most across the board was negative for the month of December, as we all know. And it's the same case for all the factors. But it was really positive for the year, which is the blue bar. And in particular, I think earnings surprise, ROE, cash flow growth are some of the factors that worked best last year. If we apply this methodology, as I described, doing a bottom-up aggregation to see relative attractiveness across regions, what is very interesting is this very clear change in allocations favoring North America, basically the US, at the expense of Asia, basically Japan, and Europe staying stable. And this is for this mid-cap segment, small and mid-cap companies. We'll look at the changes, the smoothed 3-month average on the left, and then the active regional allocations on the right. We see this change, right? In North America, very strong change favoring North America, despite these very high valuations for the broad market. But as we saw, the small and mid-cap companies have lagged behind, and that's part of the story here. Why this is showing this change in allocations for North America. And in terms of sectors, a little more stable here, but still favoring financials and industrials. Again, for the small and mid-cap segment. Tech, not that much of an allocation here. As you can see there, it's the 5th bar from top to bottom. And in terms of the 3-month smoothed average, taking away from energy and financials, adding to healthcare and technology, a little bit to materials, and financials, the clear large allocation, active allocation from the point of view of the model, followed by materials and discretionary. So a lot of cyclicality there suggested by the model. Now moving on to the large cap model, similar situation, only for the last month was greater magnitude, the negative performance of all the factors for the large cap segment. And also similarly for the large cap segment for the full year, a larger magnitude in terms of the factor performance for the full year. Momentum was the biggest performer, and obviously the momentum is a lot related with size, large caps, mega caps. But the more fundamental factors, I think, return on equity and cash flow, especially cash flow yield, were top performing factors. And we see a similar situation from a regional allocation, only stronger in terms of allocating a lot more to North America, US, and taking away from Japan. We see that in terms of the 3-month moving average or month-over-month average, and the allocations. That's an important thing to mention here. In the case of the large cap model, we started with the model started with a relative underweight, and therefore the model is kind of catching up to the North American allocation, still being actively underweight, slightly underweight. And finally, sectors, financials, similar as in the small and mid caps. Financials is the largest sector allocation, followed by industrials and consumer discretionary, as we can see here in this chart. And also active allocations. I think it's interesting. The model is suggesting an active negative allocation to technology, which, by the way, is where most of the expensive names are. So that's the model allocation review. I'll stop right here. Pause for a couple of seconds in case there are comments or questions. And if not, then that's it for today. Thanks, everyone, and see you next month. Bye.